Hi, welcome back, everyone. I hope you have enjoyed visiting our sponsors' virtual rooms and you will have more opportunities at the upcoming breaks. Right now, it's time for us to start our first panel, a discussion focused on climate change risk. And we're pleased to welcome to the virtual stage our distinguished speakers. And they include Arnold van Rijn, Chief Investment Officer, Asia Pacific Equities at Robaco. Arnold has over 25 years of experience in the asset management industry and is a member of the listing committee of the Stock Exchange of Hong Kong. Chitra Hepburn is Managing Director and Head of ESG APAC at MSCI, where she is responsible for the company's ESG research division across the region. As Head of Market Development, Kenneth Hui heads the Hong Kong Monetary Authority's efforts to enhance Hong Kong's competitiveness as an international financial center. Satoshi Ikeda is Japan's first Chief Sustainable Finance Officer. He is charged by the Financial Services Agency of Japan with planning and coordinating the promotion of sustainable finance, both domestically and globally. Further details of their professional backgrounds can be found on our event website. And we would like to welcome back Mary Lang, CFA Institute's Head of Advocacy Asia Pacific, who will be moderating our session. So over to you.
Thank you, Laura, for the introductions. Hello again, everyone. Good to see you all here. I'm very excited about this panel and the discussion we're going to have around climate risks. Without a doubt, the issue of climate change is on the lips and minds of everyone, from governments to industry, and of course, in the broader society. And today, we're going to take advantage of the different perspectives we have on the panel and zoom in on how the financial services ecosystem are responding to climate risk. We're going to talk about net zero plans, the data that is required to enable a just transition, as well as the role of investors in engaging with companies. Last year's COP26 underscored the urgency to decarbonize, and there's been a rise in commitments to reach net zero at both the national and at the corporate level. There are very many different plans out there and many different policy options, each with its own complex and nuanced trade-offs. So with all these activities, separating the noise from the substance can be challenging. So in the first part of our panel, we're going to delve into the finer details of net zero. And with that, I'm going to ask my first question to Chitra. So Chitra, perhaps we can set the scene for our audience. What does net zero mean? I mean, is there that more than meets the eye? And what are some of the promises and pledges that we are seeing from companies and from countries? Thank you.
Thank you, Mary. I think what we've seen is a lot of hype and talk around net zero, particularly just before COP. And what we have seen is that most leaders, companies and countries have risen to that by making a pledge and making a promise. What that is in reality is them acknowledging that there is a problem that needs to be solved, and for them to say, we're going to do something about it. Now, the target itself, for a lot of leaders, they've gone ahead and given a date. And to then see what actually happens next is what's really key right now. So I think the pledge is one part of it, but really how they're going to get there is what we're looking at. And what that means is you need to have measurement in place, ways to monitor and track, and also for them to be disclosing that sort of data and progress on a regular basis. So the COP, as you know, has been taking place every 5 years. I think what changed this time is that they've brought those milestones a little bit closer and said as of next year, that a lot of these companies are going to have to disclose every year on how they're getting closer to the target and what they're doing specifically to reach that net zero target. Decarbonization means different things for different industries. And we've seen so much progress being made in terms of people talking about what sort of measures need to be taken, but it's not something that you're going to see happen overnight. So we're looking at how meaningful these promises are. And one of the key things that we need to see is how, let's say, realistic some of these targets are. So when they say we can get there in 10 years, I think what we want to see is exactly year by year, what is that pathway? What does that look like?
Yeah.
And what sort of, thank you, Arne, just looking at really what they're going to do to get there, and whether or not they're being open about some of those measures and the progress that they're making. The more transparent they are about their pathway, the easier it is. Now, for companies like us, when we're looking at what they're disclosing, that's one part. And for those that don't disclose, then we end up estimating on their behalf. So really, it's in their interest to disclose what they're doing, because chances are we don't know the whole story ourselves, and the estimation may not be the full picture. So just to give you a data point, to reach net zero in the coming decades, the listed companies on our ACWI index, so there's more than 9,000 of them, they would need to reduce emissions by an average of 10% every year to get there. That's a lot, and that's a huge commitment. So, but the track record, if you look back and you look at what's actually been done, there's only a fourth of the companies that actually do that. So we have to make that differentiation. The other thing I want to say is there's a new term called greenwashing that's going around, and that's sort of looking at the intent that a company has, which is obviously a good intent, but then it needs to be backed up by action and measurable action. So this is really where we're looking, the verifiable commitments. And apart from company pledges, what I wanted to mention about the COP is this year there was greater emphasis on finance as an industry and their disclosure agenda. So 130 trillion US dollars of assets under management were pledged towards this net zero target, which is saying a lot, because we haven't had those sort of numbers being pledged before. So that was one thing. I think the other thing to bear in mind, of course, is that regulators play a big role in sort of shaping that agenda. And so, of course, we'd love to hear from our other panelists on how they're addressing this, and as practitioners, what they're seeing on this transition pathway. One last thing I wanted to add is one of our clients had mentioned, and I thought it was quite succinctly put, that in 10 or 15 years, what they're looking at is carbon tax, cost of capital, and also insurance premium. And all of that is going to eat into their profit margins. And so really, whether they want to or not, net zero is an imperative. So it goes beyond just calling it sustainability. It sort of becomes a business survival sort of tactic, if you like. I think I'll hand it back to you now.
Thank you, Trisha. I think there's a lot to unpack there, and we'll come back to that maybe when we have time. But let me turn to Kenneth next. Kenneth, I know that the Hong Kong Monetary Authority has a decentralized approach when it comes to sustainability and climate risk. So what's your focus and what's your perspective in achieving net zero?
Yeah, perhaps I can use what Hong Kong and mainland China have been doing to illustrate some of our thinking. So as many of you are aware, both mainland China and Hong Kong have made commitment to achieve net zero. In China is peak carbon by 2030 and then carbon neutrality by 2060. And in Hong Kong, it is carbon neutrality by 2050. But I think as Chicha quite rightly pointed out, how to get there is key. And here, even just looking at Hong Kong and mainland China, the pathway is vastly different. Hong Kong is a relatively more developed economy with a heavy service sector, and electricity generation make up 2/3 of our carbon emission. And in Hong Kong, electricity generation is done by 2 regulated power companies, and 90% of the electricity is used for building. So that kind of explains some of our approach. So for example, we focus a lot on reducing carbon emission during electricity generation. We try to shift away from fossil fuel to renewable energy, non-carbon energy sources. And we also try to reduce carbon consumption, energy consumption at buildings. Whereas in mainland China, a relatively developing economy with a heavy industrial base, there is a strong focus on energy conservation and pollution reduction at industries such as steel and iron, non-ferrous metal, building material, and petrochemical, and all that. So there are quite a lot of implications for those of us in finance. Chitra talked about Disclosure and transparency, I very much agree. And I think there are a few other kind of issues worth considering as well. First is the amount of financing needed. In mainland China, for example, it is estimated that at least 100 trillion RMB is needed in the next 30 years. And even in a relatively small place in Hong Kong, we are looking at $250 billion Hong Kong dollar over the next 15 and 20 years. So it's a huge sum of money that we're looking at. But because of the differing pathway that I mentioned earlier, the kind of investment that contribute the most to carbon emission reduction could be different in different markets, in different countries. And as a result of that, there are certain things that we need to pay attention to. One thing is, I mean, Chitra talk about greenwashing, but I think an older problem is greenwashing. And a lot of people put their hope on countering greenwashing, on having some kind of global taxonomy, something that define what is green and what is not green. I think we recognize the importance of that, but because of the differing pathway, we also recognize that there could be a legitimate reason for different countries adopting different taxonomy. So this is something that we have to balance and think carefully about. I don't mean to say that we're looking at a fragmented green finance market. Quite the contrary, I think. I think a lot of us are making effort to create a more globalized market, if anything. So say, for example, in carbon credit, just a few months ago at COP26, there was an agreement that we should try to allow the transfer of emission reduction across jurisdiction. As many of you know, right now, carbon market is rather fragmented. So if we manage to create this kind of globally connected market, that should hopefully help to improve efficiency and reduce costs in carbon emission. In Hong Kong, we're looking at how to capitalize on that at an interregulator forum. I think it's still kind of early days, so it will be interesting to see how that play out. So yeah, I think that's all for me for now. I'll pass it back to you, Mary.
Thank you, Kenneth. I think the idea is interesting, right? That finance is globally, that needs to be globally consistent, whereas for different countries and different places, they have different ways in achieving this net zero target. Let's turn to you, Anu. Great to see you here. Robaco has been ranked top for responsible investing in previous surveys. And I think the audience would love to hear your perspective on climate and on net zero. How much focus are institutional investors really placing on net zero, and how are they approaching this puzzle?
Yeah, so indeed, thank you, Mary. For Robaco, this has almost come naturally because our company stems from a country where there's been a lot of pension funds always around. It's been a very developed pension fund industry. But it's the pension funds also that have been pushing a lot for ESG in general, but in the last decade also particularly for climate and climate transition. So that's made it easier for us to actually also find fertile soil amongst our clients to talk about these kind of issues. And it's interesting to see now actually that this has become the best common ground we can find in ESG. I mean, there's a lot of talk about what is socially acceptable behavior. Governance is not the same in China as it would be in the US or it would be in the UK. But on environment, we can all agree that we're heading for a big problem here and we need to do something about it. So that's also making life easier from the point of view that we have collaboration from all sides. So definitely there is a lot of interest from our clients. And then that also goes into the details then of how much do you want to emphasize that? And sometimes it's just very strictly that some pension funds just want to reduce carbon emissions as much as possible. And then you can say, okay, well then don't invest in energy or utilities. Or you would say, and that's I think something we'll discuss later, well, maybe we should all work together because we can't live without energy. So there is clearly that element to it as well. I need my glasses for this. So what we do at Robaco, and that's actually quite different from many others, I feel, is that we're really trying to incorporate this kind of energy transition also into the models of the companies that we invest in. So we've been talking about how to do that exactly. So now what we look for in many cases is then companies that will need to pay up for CapEx in order to reduce their carbon emissions. We're trying to include that also into our models in sort of reduced cash flow, therefore, for the company, or increased CapEx. And when you talk about carbon pricing, that's also one where you can sort of stress test the companies that you invest in and say, well, if we're going to use today's European carbon pricing for this company, what will happen to their future cash flows? So if you do that, and we've had discussions also with Japanese companies around that, some of them find that actually 2/3 of their cash flow is suddenly gone, right? So then they realize, wow, this is really impactful. We need to start thinking about that. And that's, of course, also where then, the mechanism that you talked about plays an important role. If we're all going to pay 75 euros per ton, or even more in the future, then a lot of Asian companies are in deep trouble. So it may work very well to have a carbon pricing mechanism, but it may also kill some of the industries. And of course, governments and regulators need to be careful with that too.
So that gives gives a nice segue to our to Aketa-san, right? Hello, Aketa-san. Thank you so much for being here. In Japan, the FSA has been active in supporting the financial and the corporate sectors in managing and understanding their climate-related risks. Given what Anu has just said, can you talk a little bit about your thoughts on helping the financial and the corporate sector on their journey to net zero, and in particular, what can we look to help this journey? Is it technology or is it something else?
All right, thank you for that question, Mary. Well, obviously, the addressing climate change is a system change issue, and so how that system change can happen is very much the question we must answer, and also the financial system or financial sector, the financial institutions must answer. And so, as a regulator, we've been trying to fit the financial system, financial sectors, and each financial institution into that overall framework for driving that change. And so obviously, one of them is to address the greenwashing, because that will certainly direct capital flows towards the wrong use. But also, because it's a system change, there's a certain element of transition planning or transition engineering towards the achieving carbon net zero. So it is necessarily involved with a certain engineering technology issue. Well, as Kenneth mentioned, that the country who has a certain heavy industry and as an important industrial sector, how can they reduce the carbon emission through certain engineering technology innovation is a very much key question that we must answer. And so some estimate that 60% of the carbon reduction will be achieved through the existing technologies, but other 40% must be achieved through certain new technologies, such as the hydrogen-based steel production or something like that. So while we need to accelerate the adoption of renewable energies and electrifying the certain energy and shifting from the fossil fuel to electrified and renewable energy sources. But we also need to address that key question, because we do not have all the technology we need for achieving carbon net zero. We need to accelerate the investment for such kind of technology.
Yeah,
and that
absolutely.
kind of technology even includes a certain carbon reduction. a carbon removal technology as well, because we are aiming for net zero. So inevitably, there is going to be certain carbon emissions even after we achieve that goal. So that's why Japan FSA has been placing a very much emphasis on developing the transition finance framework through which we encourage financial institutions to engage with the corporate sector, even from the hard-to-abate sector, to plan a transition toward net zero and link the financial activities with those kind of transition plans, so that the industry move forward with the firm commitment to achieve carbon net zero. So as you said, the technology is a very important component for achieving carbon net zero. Thank you.
So when we unwrap this net zero discussion, we have many layers to it. And I think a key layer is the issue about data and disclosures, right? An integral part of a credible net zero plan is robust data and robust assumptions. And expectations around the quality of climate disclosures are rising. And we are seeing TCFD reporting fast becoming BAU. And many more companies are now producing climate scenarios. So that's all good. But on the other hand, I think that there's still issues with data. And many investors are turning to alternative data sources to supplement their analysis. But even when you have collected a meaningful amount of data, feeding that in, bringing that together, feeding that into your models, whether they have climate models or DCF models, and translating that output into something that's decision useful can still be challenging. So in the next part, I would like to get our panel's views as to what the progress has been on this area, and if we are seeing emerging best practices. So Kenneth, may I start with you? So what do you see as the key data gaps? And can you talk about the various approaches you're taking with respective to, for example, physical versus transition risks?
Yep, sure, Mary. I think your introduction is really very accurate. Data is fundamental to many of the things that we're doing here, from launching new products to managing climate risk, et cetera, et cetera. We, in Hong Kong, we set up the Center for Green and Sustainable Finance last year as a platform to coordinate official, private, and academic sectors' effort in this area. And what we found is this: we've identified 10 key data gaps related to either physical risk or transition risk. And we noticed that there are slightly kind of different difficulties when we try to fill the gap for different types of risk. On physical risk, the issue is more about scattered data sources and a lack of sufficient granularity. So, for example, to assess the physical risk facing a specific asset, like let's say a property, we need local climate data. We need information about historical claim and losses of similar assets around that area. We need potentially death and accident figures, and all such information and data have to be somehow linked together. Right now, many of these data are available. They could be residing at government or observatory, or they could be residing at financial institutions, particularly insurers. But the resolution of some of these information may not be high enough, and we have to find a way to link everything together. So when it comes to data on physical risk, a lot is about digging out the existing data and then enhancing them. On transition risk, I think you alluded to it earlier. The challenge is as much about data as about methodology. So if we think about it, when we think about the impact of transitioning to a low carbon future for a company, we need two kind of broad categories of information. First is information about the company, its carbon footprint, its transition readiness, etc. And then we also need more macro data, such as the forecast on carbon pricing, as Arno discussed earlier, technology advancement, as Akita-san mentioned earlier. Company level information, I think that the gap is being filled. You mentioned TCFD. And indeed, we're seeing a lot of companies are disclosing along the recommendation of TCFD, either voluntarily or sometimes as part of the regulatory requirement in Hong Kong. For example, we're requiring mandatory disclosure by 2025. And we all know the International Sustainability Standard Board is working on some kind of baseline sustainability related disclosure. So hopefully this part of the data gap is being filled. On macro level information, I think it's trickier. A lot of the modeling, there is a lot of uncertainty embedded in it. Regulators, official bodies were working on it under forums such as the NGFS Network for Greening the Financial System to develop tools such as climate scenario. But I think the tricky part here is how to adapt these generic model and tools to local condition. So I think overall we're making progress. Perhaps not fast enough, but we're moving on the right direction, I would say.
But it sounds like a lot of work has already been done. But I agree. I think it's one of those things that's the glass half full, right? So depending on which half you look at. Anu, may I turn to you next? So I think as an investor, data integrity must be a huge issue, right? Otherwise, it's garbage in and garbage out. So what can be done from your perspective to enhance data integrity and reliability? And what are some of the alternative data sources that investment managers are using to supplement corporate disclosures?
Yeah, so what can be done is being done at the moment, and that is to set global standards, right? So SASB has been at the forefront of that with setting some standards, and the accountants are now also very happy jumping on that new business opportunity of certifying certain carbon data. So we'll get that probably quite quickly, because until now, and particularly also here in Asia, it's been very messy reporting with numbers that were sometimes not including subsidiaries or excluding certain other parts of the business. So the numbers are only gradually coming to sort of a stabilized number. And that means that you also cannot really compare 2020, 2021 data to 2018, 2019 data, because the definitions then were, well, largely non-existent. So that means indeed, if you're thinking about the pathway of getting to net zero, and what Chitra was also referring to, you want to get milestones along the way. But what is the starting point, right? The starting point is still actually only being set right now. So we'll get that pretty quickly, I'm sure, because of the attention that everybody is now spending on this. So I'm not too worried about that. But yeah, it's very early days. We're just getting started there. And also what we're struggling with, and this indeed is interesting, sitting on the listing committee then and trying to define standards for Hong Kong companies here. We're also dragging a large tail of small companies that will need to rely on advisors or consultants to get them the data that they cannot produce themselves, essentially. There is, of course, scope 1 and scope 2. Maybe you can still determine that. Scope 3 is a completely different field, and we don't even know what that will actually settle at right now. So there is still a lot of uncertainty about those numbers. So if you're asking very small companies listed in the exchange to also provide a full set of data, it's almost impossible. And that means that you're going to have to settle for sort of a common denominator that is not ideal and may not be enough for large companies, and actually already quite a challenge for small companies. So what we've seen, for instance, in the UK, and you're starting to see that in Japan too, is that we're going to segregate boards and say, well, from the prime board, we expect a higher standard of transparency and reporting around carbon data than we do from our secondary board listings. And I think that is probably a good way forward, because of course it's the large companies that will actually determine the outcome for the world of whether we're getting to net zero. The small companies matter too, but let's start with the big ones. And so I think that will happen to start with the big ones and have them develop a pathway. And again, back to Chitra's initial question, then we are also looking at milestones there. When we invest in companies, we of course meet with them 2-3 times a year. We need to keep a pulse on what's been the achievement this year and how does that compare to last year, and not just saying, okay, by 2030 we'll be there, because by then, all the people responsible have already changed jobs. So that, you need to really have an annual path there.
Yeah. Thank you for that. I can't agree with you more that proportionality needs to be taken into account when we design rules for companies with varying degrees of size and responsibilities. Akita-san, let me turn to you next. I read that the FSA has just established a specialist committee on ESG evaluations and data providers. And I know that there have been concerns in Japan and elsewhere that ESG ratings are quite divergent, right, both in terms of the outputs and methodology. So can you please talk a little bit about FSA's thinking and what role do you think securities regulators should have in this area?
Right. Yes, because the ESG rated data is becoming more and more important in the capital market. There is certainly concern over the role of ESG data and ratings providers. Well, that is the issue that the IOSCO is also trying to address, and along with the recommendation made by IOSCO, Japan FSA is also working on that issue. Well, what we are concerned about is not the divergence of ESG evaluation by those providers. We see that there's a healthy competition and certain in pursuing certain diversified evaluation, and so as opposed to the credit ratings, which seeks to analyze the credit worthiness of a certain company. I believe that there is likely a certain divergence in the end, but well, people often confused with those divergences. So it's very important to make sure that certain transparency around what kind of methodology those providers are adopting, and also the what they are trying to evaluate in the first place. So to address those kind of things, well, the Japan FSA established a certain committee on discussing that issue. If I put this issue in the overall context of the data gaps, well, I would commend the efforts made by those providers, because in 5 years ago, maybe, there are so huge data gaps, and the data providers have been trying to, well, bridge that gap through asking companies certain information or making certain estimation. And that is the part we must commend. But at the same time, well, when we started the work of IOSCO, we were so much worried about that the huge importance they are taking in this market. We thought we may need to address that issue. But well, ISSB is coming in, and so ISSB will provide a certain baseline of climate-related metrics. So there is a certain claim that the role of such ESG data providers may diminish. But I believe that the ESG data provider continue to act as a gatekeeper for the ESG and climate-related data. And I think they are continue to be important in the capital market, because I don't believe that the institutional investors will be satisfied with the set of the metrics provided through the ISSB standards. So there is certain motivation for out-maneuvering others. So ESG data providers will be relied upon in that context in the coming future anyway. So I hope that our work for enhancing transparency around those data providers will also continue to be important. Thank you.
Thank you, Akeda-san. Well, it's good to hear that there will be a continuing important role that data providers to play. So Chicha, for this part, I think you have the last word, because as a service provider, you'll be bringing all these perspectives together to make it work. So how are you going about that?
Well, firstly, I want to thank Ikeda-san. Very relieved to hear that we still have a role to play, so thank you for that. I'm just going to sort of refer a little bit to what we've been hearing so far. So on one hand, there are these data gaps that Kenneth mentioned, very specific ones. If you're looking at physical risk, transition risk, and believe me, we've been working on these issues to sort of address how best and how many sources of data can you have that are reliable. You want quality data. Just plugging the gap alone is really not a solution, because you can get all sorts of data today. You can scrape data from just about any source, but that's not the solution to the problem. So I think what we've been trying to do is identify quality sources first. I think the other point I think Arno had also raised out there was when you're looking at very specific milestones that have been put in place, say for climate in this instance, I think it sort of almost compels institutions to start disclosing more and working on those data points, because they know sooner or later they're going to have to do something about it. I don't think that existed earlier, to Ikeda-san's point. About 5 years ago, there wasn't any impetus to do that. Now, when I look at what we've just discussed, on one level, you've got from a regulatory angle, or let's say from a harmonization perspective, there are enough bodies looking at it. IFRS, previously SASB, you've got TCFD. So we've got quite a lot of these, the alphabet soup lot that are actually helping to set, if you like, the stage to then or create some sort of motivation to then disclose. But on the other hand, what we've seen is there's also a lack of understanding of what needs to be disclosed and to what extent. So I think Arno had brought that up earlier, where some companies are quite happy disclosing scope 1 and 2 selectively on certain aspects of what they do, not everything. Now, scope 3 clearly is something new that we're looking at. The EU regulations have made it more and more important. And so I think that's not something we can run away from. And then, you hear other people talk about scope 4, sort of avoided emissions, but we haven't even got there yet. We haven't got our arms around scope 3 entirely and been able to cross that bridge. So I think there's a lot of work we need to do around that data piece. The other thing I also wanted to talk about is it starts to become meaningful for practitioners, like all my fellow panelists, when it has some sort of a forward-looking implication. I think data as just a snapshot of where we are today is one thing, but what we're trying to establish is some kind of tracking or monitoring that shows us what is the trend, which really then puts the onus on the company and sort of puts a spotlight on them and what they're doing about it. So where they are today is one thing, what they're going to do about it is separate. And that's where these scenario analyses that Mark Carney brought into place is so critical. Because what they're saying is, here, run this scenario analysis for me, stress test your portfolio and show me what is that going to look like in 10 years, 15 or 20 years time. And we've got a tool that actually looks at, if you're the only company in the world, company ABC, let's just take a look at your impact on global warming. Are we going to be in a 3.5 degree world or a 2 degree world? I think those sort of things are very compelling to make companies take some sort of responsibility. Final word I wanted to add was, in China, we noticed when we started to rate companies there, how quickly they started to come up the curve on understanding what we were measuring. We had to let them know it was about financial materiality, and we were looking at what was core to their business, not their ancillary charitable activities or how many trees they'd planted. And since then, 67% of them have gotten so much better on disclosure. So I think, yes, in Asia in particular, lots of room for improvement. But on the flip side, this is where we're going to see most of the movement, if you like, in terms of disclosure improvement.
Okay, thank you, Chicha. We have about 8 minutes till the end of the discussion, and I want to change lanes slightly and talk about engagement versus divestment. I think for a lot of institutional investors, they've been placing a lot of pressure on companies and boards to influence behavior, but investors themselves are also under a bit of pressure from their clients to commit to decarbonization targets. So the debate between engagement versus divestment has never been more relevant. For those who are pro-engagement, right, we think that it's the right thing to do, that's the only way to change or guide behavior. But on the flip side, if one doesn't sell, one may be holding an asset all the way down, and that's not good for the ultimate client either. So I would like to find out what our panel thinks. And Anu, please, can we start with you? What's Robaco's stewardship policy, and what is your approach in influencing behavior?
Yeah, so indeed, it seems most logical to go for engagement. And it's also where we're putting a lot of emphasis with large engagement team, both here as well as in Rotterdam, of course, where our headquarters are. But you can only reach so many companies at the same time. Engagement is a very labor intense proposition. So you can focus on portfolio holdings if you run fairly concentrated portfolios. If you have broad portfolios, and we see that with some of our quant funds, for instance, you have to go by the numbers and basically also go over the top, essentially. And particularly here in Asia, I think that is also part of the engagement approach should look like, is that you're doing a lot of government engagement or regulatory engagement, where you sit down with the regulator in China, you sit down with the regulator in Australia and say, well, we think that you're never going to get there like this. And particularly in Asia, I think that matters a lot, because what we've seen is that companies would then be open for engagement, and we do find happily that many companies are open to engagement, but they would only go so far. At some point they would say, well, no, clearly we're not going there because the government doesn't even ask us to do that, so why would we do that? It's going to hurt our profitability, or it's going to hurt the country as a whole, the development of the country, particularly in emerging markets, of course, so we're not going to go there, right? That's all discussion about coal, for instance, in countries like India. So if you want to change that, you really need to go over the top. So engagement so far has been mostly a bottom-up thing, but Robaco has also started recently to do more top-down engagement, where you're actually sitting down with regulators. And of course, we would like to do that combined with other asset managers and talk about these issues in collaboration. So I think that is a very important thing to be aware of, particularly in Asia, where compliance culture is quite high, I would say. You only do it when the regulator asks you to do it.
Yes.
So we need to do that too.
So perhaps I can turn to Chicha, because Chicha, I'm sure you have a lot of data on this, right? So how impactful are these strategies? Can we have definitively say that one strategy is superior to another?
To Arna's point, I think, it takes a combination of things. So I think engagement, obviously, most of the investors we talk to say that's their first port of call. They start with engaging. And I think that's the right way to do it, obviously, because divestment doesn't solve the bigger problem, the systemic risk that exists, right? So you just take it off your portfolio, but then it goes on to someone else's portfolio. So how does that help? So I think there is that. But I think earlier we were talking about this amongst us as panelists, and one of the points that did come up is engagement does have its limits. You can keep engaging, but if you're not seeing enough progress, then I think you sort of have to draw a line somewhere and say, this is the point up to which I will engage, and then we need to see, some sort of progress. On that note, one of the things we've been doing on our flagship index, the APAC, we've been looking every quarter. We do a net zero tracker. And so what that does is it calls out the top 10 that are actually doing something quarter by quarter. We can see the progress and measure it. And it also calls out the bottom 10, I'm afraid, which shows we've done absolutely nothing from quarter to quarter. So I think that that sort of measurement and tracking is important. And if it's put out there transparently, it actually shows you which companies are responding to engagement, because there's no way that they're not being engaged with. I think their shareholders are definitely letting them know and putting some pressure on them to do something. Question is, are they doing anything? Are they doing enough? And are they doing it quickly enough? So yeah, I would say it's got to be both. But yes, engagement would be key. Arno, did you want to add to that? I thought you were going to say something.
No. It's just my microphone, I guess.
Okay.
So let's turn to Ikeda-san next. Ikeda-san, I think a lot of people like Anu are looking to you, right? The regulators to make sure that to guide behavior. I also understand that many markets in Asia are quite bank-centric, and banks' perspectives may be different to an investors. So what are you seeing in your market in terms of how banks are working with investors to motivate companies to tackle some of these issues?
Right. Well, as Andrew said, that they are very much compliance conscious, and actually the Japan FSA is planning to issue a guidance on engagement soon. So that's the new move. But I would say that the bank is very centric to the Asian financial system, and the bank's move is very critical in driving the move towards carbon net zero. And well, often that the banks tend to focus on the cash flows of a company. But when we address this climate change issue, I believe that the banks need to look at how that cost of capital will change as a result of failing to address climate issues. Because cash flow may not be influenced in the short term, but estimation of the cost of capital requires the longer term horizon perspective. So bringing into that the long term perspective into the bank's decision making, I think the certain shift from the cash flow based lending to a certain enterprise value based lending is necessary. That's my perspective. Thank you.
Thank you, Ikeda-san. Kenneth, last but not least, I know that HKMA plays a key role in some of these discussions. So what's your perspective?
Yeah, thanks, Mary. We kind of look at it from a few perspectives. So as the manager of the exchange fund, we are one of the largest asset owner in the world. So on that front, we also have a preference of engagement over divestment from the investment perspective. It's really to make sure that we can continue to maintain a diversified portfolio, and to make sure that our returns are not harmed. And also from the environmental perspective, I think Chitra put it quite well. By divesting, you're basically just passing the problem to somebody else, and want to make sure that we retain the ability, the connection with the company, so that we can continue to engage them. I think Chitra's example about how by talking to companies in China about the data need and all that, it actually set a benchmark for them to significantly enhance their disclosure, enhance their carbon reduction. I think that's a good example of how engagement could potentially bring results. Having said that, we do have a few other different hats as market developers and as bank supervisor. We do recognize that different investors have different perspective, and our overall approach is to kind of highlight the issue, draw people's attention to it, share with them the options that are available, and also give them the necessary information and material to make the decision. So similar to what JFSA is doing in Hong Kong last December, our banking colleague issued a circular to the banks on the sound practice to support the transition to carbon neutrality, where we highlighted a few options that banks can do to reduce finance emission, to help client to do the transition. So these are all the things that I think financial institution could consider doing, rather than just a kind of stark choice between divestment and engagement. And I guess the disclosure, the more data that we would be able to provide to investor would also help them in making the decision. And I guess ultimately, as banks and asset manager, as they focus on managing climate risk, they would likely to, reduce their climate risk exposure. So whether it's divestment or whether it is, engagement, I think the outcome from an environmental perspective is probably, moving at a similar direction towards a similar outcome.
Thank you, Kenneth. Well, I personally find the connection between stewardship and value creation fascinating. And later today, we actually have a panel on shareholder activism that's moderated by my colleague, Siva Ramachandran. So for those of you who are interested, please tune in for that. I'm afraid this is all we have time for today. I've learned so much, and I wanted to say a big thank you to all our panelists here. I'm immensely grateful for the inspiring discussion that we've had. I think a round of virtual applause is in order. And with that, I wish you a very good day. Thank you.
Thank you.
Reducing our carbon emissions to net zero may be our biggest challenge yet. There's no single action that will lead us to carbon neutrality. But there is a single source of essential sustainability intelligence, S&P Global Sustainable One. Uncover risk scenarios, reveal transition pathways, and optimize your net zero opportunities with our unparalleled data and insight. Accelerate to zero with us.